Diversification cannot protect you from systemic risk. Diversification can only protect you from risk of individual asset failure. And so those who are proponents of diversifying away your risk through passive index investing, just keep buying, are assuming that the system has no risk of failure. And in this video, we're going to discuss why that's incorrect. Ready? Let's dive in. As the very popular saying from Warren Buffett goes, diversification is a hedge against ignorance, and it makes no sense if you know what you are doing. And so the idea is that most people have no idea what they're doing, so you should diversify in order to hedge that ignorance and get rid of your risk. And so instead of going all in on Meta after, they have, all the free money and boom, and they capitalize on Web3 and the metaverse hype, change their name to Meta, and then they crash, wiping out hundreds of billions of dollars in wealth, which isn't funny. You're hedging away that ignorance because you thought it was going to be the first $10 trillion company. And instead of that, you're going to buy the entire S&P 500 and only lose 20%, 25% over the same time period. Now, for most people, there's a lot of sense in that. However, with just a little bit extra work, many people are able to get outsized returns by just doing a little bit of research on what the companies are doing. Looking at their revenue, looking at their profits, looking at their expenses, just doing a little bit of basic fundamental analysis. And if you don't know how to do any of that, I got my bear market investing guide that you will walk away from it knowing how to identify the best companies in the world and figure out what price you should be buying them at so that you know when they're on sale. Link is down below. But most people don't do any of that. And so the idea is diversify so that you don't have that risk. But here is the problem with that. The assumption is that the system has no risk of failure. Why is that? Well, because diversifying away from one company, the only thing you're doing is adding more companies into the mix. And the entire system is made up of all the companies. And so if you have a recession, if you have a major economic downturn, if you have a financial crisis, if you have a currency crisis, none of those risks are pushed away at all. They're not transferred away at all. You're not getting away from those risks at all by buying multiple companies that are all a part of the same index that every single pension and 401k company out there is buying themselves also. Because when everything gets sold, when everybody has to sell, everybody's going to be selling the same things. And so if you're invested in all the same 500 to 1,000 companies that everybody else is invested in, when things go bad, everybody is selling the same things that you just bought. And so diversifying does nothing to hedge against systemic risk or overall economic risk. So the assumption built in to the idea, the theory that passive investing, just keep buying, will always work is that the system has no risk of failure. Everybody recognizes that individual companies do have a risk of failure. You have fraud, you have a CEO leave, you have a founder leave, you have somebody else come in, turn the company upside down, just crater it. You have fraud go on, a company that is cooking the books and is doing all sorts of things that are not actually producing profits when they said they were. You get companies that go bankrupt all the time. So everybody acknowledges that companies have risk of failure. But the people who advocate for, hey, just keep buying and just spread it around through all the major indexes and just continue to dollar cost average in and do nothing other than that, what they're really advocating and what they're really saying is, while individual companies have risk of failure, the system does not have risk of failure. So any potential downturns are eventually going to be smoothed out in the end, and the economy will just continue to grow. What's the problem with that? Well, look at history. Nations, they rise and they fall. Economies rise and fall. Currencies rise and fall. So economies and systems are actually at risk of failure. Now, it's hard to see when we have our little small human lenses on and we think, 3 years is a long time, let alone, 10 years, 30 years, 50 years, 100 years. And in the scheme of things, these giant systems, the ones that are at the top that make it big, the big empires last for 150 years. 200 years, it's really hard to look at things from that long-term of a perspective. But when you do, you realize, hey, the system that we're living in, it looks from many measures like it's nearing its end. It may not be right at the end on a verge of an imminent collapse, but it's been chugging along for a while on steam. It has been moving forward on the momentum of decades before of massive saving surpluses that have all been spent. We now have a massive accumulation of debt, which debt equals risk. Debt is leverage. Leverage equals risk. So we've got massive leverage, no savings. We're in a very fragile financial system where we have inflation as high as it's been in decades. And by many measures, it's the highest it's ever been for the dollar. And we're dealing with all of these things at the exact same time. Deglobalization, other countries around the world trying to get off the dollar, energy crises around the world. So we have a lot of factors piling up together all at the same time. And still, people are saying, just keep buying. Everything will be okay. And it's possible that everything will be okay. As long as you recognize that diversification throughout the stock market doesn't protect you from dangers to the overall stock market. It only protects you from dangers of an individual company failing. But if everything starts to collapse and everything starts to fail, then it doesn't matter how many companies you own. They're all going down together. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.